Your unique story, our global audience. Global One Media.
Hello, and welcome to another one of our equity research series with Chris Thompson, where we look under the hood and see the inner workings of companies to help investors make informed decisions. Chris Thompson is the president and director of research at eResearch, a company that performs equity analysis on various stocks. Hello, Chris, and welcome again.
Thank you for having me.
So let's dive right into it. You cover data communications management, or DCM, regularly, and you've recently written an update report on the company. A lot has happened with DCM since we last spoke. Can you walk us through the most recent and significant updates from the company?
Yeah, the company has done a merger recently and closed that merger. As part of that closing of the merger, they also did an equity sale as well as a sale of a facility, and then they also released some Q1 results that were quite positive. So this just focusing on the events that have happened. I guess the Q1 results are probably the easiest to go over. Q1 this year, revenue was up almost 10%. It was 9.8% to $76.1 million. And this is the old company itself, pre-merger. And that was much higher than our estimates. This has been a quarter. I think now they've had about 12 quarters or so where they've had revenue growth, which is important for the company. So they're growing organically. And they foresee that they still will be growing within the original company, the original DCM company, in the 5 to 10% range moving forward. So that's important for the company, and they see a lot of traction with their new products. They're currently a company that provides services, workflow and printing services to help companies communicate, and they have a lot of technology-based solutions that help companies do things a lot faster. And in this day and age, a lot of the the company assets, the digital assets, need to be managed and need to be able to be found quickly and sourced. So that's important itself. And then really, they earlier this year they announced and closed recently this merger with a company called Moore Canada Corporation, or MCC, which was a Canadian subsidiary of a large U.S. company called R.R. Donnelley. And so that closed. It was over $100 million in the transaction. And as part of that transaction, the company acquired 3 buildings. And what they're doing in the process of trying to deleverage the sale, they did the sale all based on borrowing. And so to deleverage the sale, they're going to sell and lease back these facilities. So one of the important things is that they closed the deal. So that was great. And then they recently sold one of the first facility for proceeds of $23 million to help pay down the actual debt facility. So that was an important event. And the next thing that they also did is they did an equity financing, again, to help deleverage the sale, in which they raised about $26 million of equity financing. So there's a lot going on with the company moving forward. And so that's why I think these events have all been very positive for the company.
And this is indeed a very positive performance in different aspects of the business. I want to zoom in on the company's post-merger updates. What other post-merger activities are in order?
Yeah, so the company, because the company bought the other company MCC with all debt, the DCM is actively trying to pay down the facility with these other facility sales. So there's probably going to be 2 more facilities that you will see be sold in the next few months to pay down part of the debt. During the sale itself, they valued the 3 facilities at around $30 million. And what they're doing is what they call a sale and lease back. So they're not actually moving out of the buildings. They're just selling the facilities and signing a 10-year lease. They believe they can raise another $6 or $7 million to help pay down the debt from the sale and lease back of the other 2 facilities. So that's the first thing that you'll be seeing announcements with the companies for the next couple of months. The other one is, they're actively working on a sales integration. What we looked at right now from our modeling of the two companies, you'll probably see revenue, increase up to about $450 to $460 million in 2023. And that's because of the fact that the merger really only took place in Q2. So you won't get a full year of integrated financials. But by next year, that the revenue, should be, more than $540 million in next year when you're looking at 2024, once the companies have merged together. So you'll see that revenue growth each quarter quite substantial, and then the annuals will really catch up next year. The company itself is now, with the merged company, believes it can still grow organically 5%. With the old company, they were looking at 5 to 10%, but with the merged companies where revenue will be doubling, they think a 5% growth is achievable, which is great. You want that organic growth. The final thing they're working on, as I mentioned before, the sales team integration, which will help drive sales. But the last thing they're working on is cost savings. And the company has guided that they think that they can have $25 to $30 million of cost savings over the next 18 to 24 months. And so you'll see the bottom line pick up with EBITDA growth in that range, which will be great for the company because they can use that additional cash flow to help pay down the debt, to de-lever the actual transaction. They want to get down to a 1 times debt to EBITDA ratio. Right now, after the transaction, they were a little north of 3. After the equity raise and the sale of the first facility, they're down in the 2, and they hope over the next year or so to get down, closer to the 1 level, which is what their target is.
This is all very impressive, and I'm sure that eResearch has factored all of those updates into its analysis. How did all of those events impact your valuation of DCM?
Yeah, well, we added the revenue in, which is going to be a boost. The margins with the MCC were a little bit lower than the margins at DCM, but they believe they can get them back up to their level. They're targeting, a 30% margins, sales margins, where MCC was more in, say, the mid-20s. And so we're looking to get those up higher to help, drive the cash flow into the company. We also are, modeling that $25 to $30 million. We actually modeled the low end of the actual business into the model itself. But when we did this, our target price went from $450 to $690. And it's all outlined in the report. So anyone who wants to see our calculations, it's a combination of a 5-year discounted cash flow, a revenue multiple, and an EBITDA multiple. So we have 3 factors. And so any investor who wants to go in and look at it can actually look at my calculations and maybe come up with their own modeling based on my calculations. As I mentioned, we believe, the revenue is going to be in the $450 to $460 million next year. So it has really step changed this company with the revenue model. And, the company itself has gone up. The stock price has gone up, from the $1.51 area. It hit almost $4 after the acquisition was announced. It's come back a bit in the $3 range. But even at that range right now, it's only trading at a half-time revenue multiple, enterprise value to revenue multiple, which is much lower than its peers, which are trading at, almost 1 times enterprise value. Some of the other, they are shifting, or DCM is shifting more into a technology-based sales with these types of solutions, which are higher margins. And if you look at comps in that space, going beyond the printer comps, you're looking at more of a revenue multiple in the 2 to 4 range. So I think, regardless of the fact that there's organic growth in the revenue, they're improving their margins. they're also trading what I believe is below their peers.
Excellent and very useful to know. And anyone who's interested can, of course, download the entire update on eResearch's website. Thank you very much, Chris, for sharing your insights and analysis.
Thanks for your time today.